Your advisor says you're on track for retirement, but here's the truth. Most investors have no idea what track they're actually on. The set it and forget it strategy sounds comforting until reality hits. Today, we're revealing the 5 truths about retirement savings your advisor probably doesn't want to talk about. All right, welcome back, everybody. We got a special guest here today, Dave Abate. How you doing, buddy?
I'm doing great, D. Great to be back.
Yeah, it's good to have you back. Our boy Tony has a presentation, I guess, so we want him to save his voice, be his best.
Yeah, he's got to rest up.
Yeah, I mean, he does talk a lot on the show, so I do understand why he wants a little time off. So today we're going to talk about the 5 truths about retirement savings that maybe your advisor is not telling you right now. So, I saw this one. I thought it was a pretty good idea for, kind of one of the end of the year topics, when things are, a little bit more quiet, I'd say. Right. So, this kind of just gives us a good kind of overview of things you should be thinking about your finances, coming up on the end of the year, and then obviously kicking off a new year here pretty soon. So, yeah, go ahead. You were about to say something?
Yeah, I think there's there's so much good stuff with this one. I'm glad we're hitting on it today. And I just had a conversation yesterday with a client on one of these, and I can't wait to kind of jump into it.
Yep. I'm the same way. I go through the list, and I was like, oh well, I talked to this client about that one and this client about that. So yeah, it's a good list from that perspective, as it's real life stuff that we're dealing with every day. Truth number 1: average returns don't equal real returns. So this is probably one of the most important things in investing. I'm sure you have lots of takes on this one. The one I'll go with to start with is, if someone told me right now, I'm not that young anymore, but still relatively young, relative to retirement age. And someone told me that I could get 6% every year in and year out, with no volatility whatsoever. I would sign up for that deal 10 times out of 10.
Sure.
And it's because there is no volatility at all in that number, so you're just getting a nice flat rate of return. Everyone should have a nice average, right? It's about kind of smoothing out that ride, and not losing a lot in the down years. Just your average rate of return really isn't going to tell you a whole lot.
That's exactly right. Like, the market, the investment doesn't exist where you get that 7% or so of just risk-free with no volatility return. That's kind of a magic bean type of investment that's not out there, but really, and that's the whole connection is when you're an investor, because of that volatility, the swings up and down, your emotions are kind of feeling excited or scared depending on how the market's performing at any given time. And that's one of the biggest behavioral things that we help our clients with, is navigating, not even navigating, but it's almost like preparing, embracing yourself that, hey, this is how it's going to work, this is how it's going to happen, here's our plan to deal with it.
Yeah, for sure. So yeah, and I think being in the business for a while now, people have certain expectations or thoughts about kind of what we do and how we do it. And I would say kind of a lot of people think, really before talking with anyone, us as advisors, we have extra tools or crystal balls that are going to help you get into good investments before anyone else knows them, and then help you get out of the way of bad investments, before anyone else knows that as well. That to a degree is somewhat true. Obviously we are spending a lot of time and effort on research and things like that, and making a difference in the portfolio that way. But what we're really trying to do is we're trying to get try to get our clients a good risk-adjusted return. That's really all we're shooting for. We want to have that nice return year in and year out while taking less risk than the average investor out there.
Yeah, absolutely. And the next one that's kind of coming up here with the sequence of returns risk, this one's like huge to me, especially when we're dealing with a lot of families and individuals that are kind of entering into that retirement transition phase. And with that, income shut off, and all of a sudden, I call it like the rubber hitting the road.
Right.
Like what that means is like now we're in retirement and we're relying on this portfolio that we've built up over time to fund our living expenses when we don't have that income anymore. So the way that we kind of bottom line this thing, if you really want the whole like summary in a nutshell, is you look at really the way to prepare for this is you're looking at your shortfall in retirement. Like how much money do I need on a monthly or an annual basis to pay my bills, right? And then how many years of coverage do I have from that safe part of my portfolio, right? Because we know storms are going to come. Mm-hmm. They're inevitable.
Yep.
And we know, like, historically, on average, the drawdown from, a relative peak to a trough back to that, previous high point is on average a little bit less than 2 years. So then we start sizing it and we say, well, how many years of coverage are we going to feel comfortable with? Because the markets at some point are not going to cooperate. And if the worst timing happens and you retire and you need to draw from your portfolio, we need to have that safe haven asset that we can draw from to weather the storm.
Yep, absolutely. Perfectly said. So yeah, your average return, not that important of a number, like Dave just explained. Make sure you have a cohesive strategy when it comes to your assets, and when you're getting close to retirement or in retirement, you got to have that income strategy so you're not selling those depressed assets during a downturn to fund your retirement. So truth number 2, we've talked about this quite a bit on this podcast, but taxes destroying your retirement nest egg. This is definitely the most overlooked aspect of retirement planning is tax planning. And that is because it's really just human nature, right? Like I would say not a lot of people wake up in the morning and say, oh my gosh, this is the best day ever. I get to go in and talk to Derek about my finances. No one's really saying that. It's some of the times, I'm telling them things they might not necessarily want to hear. It's kind of like going to the doctor, all that good stuff. So no one's really getting a huge jump on retirement planning, I would say. But if you do, you are at a tremendous advantage. And I'd say taxes are one of the most important things. And I'll just kick us off here. Building a diversified tax portfolio can be extremely helpful in retirement. And what does that mean? So saving money into all 3 levels of kind of the tax ladder. So you got, tax-free at the top, like Roth accounts, tax-deferred in the middle, so your 401ks, traditional IRAs, and then non-qualified. So, your brokerage accounts, cash accounts. Every IRA withdrawal is taxable in retirement. So you've been told your whole life, save as much money as you can into your 401k. I'm here to tell you that might not necessarily be the best strategy for everybody. We need to look at what your lifestyle is like and how you're getting that income in retirement and how it's going to ultimately be taxed, because it can make a huge impact on your overall situation.
Yeah, Derek, right on the nose with this one. And it's like, to me, the key is like working with someone that's helping you understand the rules of the system, the game, right? Mm-hmm. We're in a progressive income tax environment. Rates go up as your income levels go up. So understanding how the rules work and how you can sequence your returns to make your money last as long as it can, like that's the key to the game. Because for most people, you work for a certain period of time. We'll call it that accumulation phase. You retire, And then, there's a period of time where you're in a low income tax situation for a lot of people. And how do we take advantage of those low income tax years can be key.
Yep, for sure. Absolutely. And that's where Roth conversions come in. But again, Roth conversions might not be for everyone, right? Roth conversions, I've seen it. It can hurt a situation. Just because you hear it on the internet or on Instagram doesn't necessarily mean like that's going to be a great strategy for you. I mean, yes, Roth conversions are a powerful tool. They can help. But, what I was alluding to kind of when we kicked off this topic, if you get money into a Roth beforehand, you don't have to do a conversion later, right?
That's right.
If you do, another one that just came to mind, a lot of clients seem to, they don't want to have debt in retirement. So if they're looking at buying like a condo or a second home type of situation, inevitably I get a phone call that says, "Hey, Derek, should I take out, $400,000 and pay cash for this house?" And, usually it's all in their IRA, and usually it's a quick conversation, and the answer is no, because all that money is going to be taxed. So having a long-term strategy on how you're going to be taxed in retirement can add years and years onto your retirement plan. So number 3, Dave, any more on that one?
No, I think you unpacked a lot of it. It's good. I'm excited to hear number 3.
All right. We'll let you kick off number 3. I don't want to steal the show here.
So number 3, the truth out there is inflation is still the silent killer.
Yep.
And this one I think resonates with a lot of people, especially now. Let's think about what's going on, right? It's like it's risks comes in a lot of different forms. At the end of the day, what we're trying to do here is protect your purchasing power, right? So let's go back to the example of returns. Hey, my advisor said I'm getting 7% a year, on average. Well, in the context of what interest rate environment is in the background, that kind of gives more context and information in terms of how well you're actually doing. Now, relative to historical inflation, you're probably doing pretty good, right? Because you're keeping up with inflation, your purchasing power is being preserved. And what that literally means is a loaf of bread always didn't cost $4, right? It used to cost $2. Well, over time, things get more expensive. So just because your bank account grew, did it grow as fast as the goods cost that you're purchasing it with? So that's kind of the name of the game, is how can we protect that purchasing power?
Absolutely. And I'll throw in another client conversation, CD investors at the bank. In the last couple of years, it's actually flipped a little bit where it's not a negative. But, if you're investing in CDs because you like the nice, stable return like everyone else, you have to consider taxes into that equation. But you also have to consider inflation. So on a chart that I saw, basically over the last 20 years, there's only been 3 or 4 years where there's been a positive return on CDs after factoring in taxes and inflation. So you're when you don't factor in inflation into that scenario, you may be thinking, hey, well, even after taxes, I'm still getting a guaranteed 2.5%, but you're actually losing purchasing power over that time that you have that money in that CD. So, like Dave outlined there, make sure you're not only factoring in taxes, but also inflation into the overall picture.
Absolutely.
So, number 4, Dave, why don't you did number 3 so well, we'll have you keep going.
We'll keep it rolling. So, Derek, truth number 4, diversification does not necessarily mean protection, right? So what this is getting at is a lot of times we'll see prospective clients come through our doors and they'll say, we'll talk about some of the key concepts of building an investment strategy or constructing a portfolio, and they'll show us their statement and they'll say, hey, look at this, I'm fully diversified.
Right.
And it'll be just a bucket of 12 different mutual funds. And they all have different names, right? But really the investor may not really have a great idea of what's inside of those mutual funds, right? They're essentially a wrapper, so they can hold anything inside of them, but until you do what we call an X-ray and really examine like the securities inside of those mutual funds, you really don't necessarily know what you're holding, without doing that level of analysis. And what we find out is there tends to be a lot of overlap. So the two funds have different names, but 80% of the holdings are exactly the same. So that's really leading to you maybe being more concentrated and less diversified than you think you are.
Absolutely. I mean, this is probably one of my bugaboos out there about talking to people about their investments, because that's exactly right. There's so many mutual funds out there that hold the same stocks that you can own 10 different mutual funds and ETFs, but you're invested in largely the same thing. And again, it doesn't come up when the returns are decent, right? Yeah. Especially when they're, you got overlapping investments in good performing sectors. You might think your portfolio is perfect, but like I mentioned earlier, just an absolute rate of return isn't necessarily what we're after, right? We're after that risk adjusted return. So the more overlap that you have, the less that outcome is going to be likely to have a good risk-adjusted return.
That's right, Derek. And one other thing I just wanted to hit on in the spirit of this, set it and forget it. A lot of times there's been so much PR or talk about, hey, all you need to do is buy the S&P 500 and you're golden. There's right. No other action required after that. When you ask or when you go under the hood of all these ETFs that represent the S&P 500, you really look at it, most investors, I don't know if they realize it is comprised of 500 stocks, right? But it's market cap weighted, right? So that's a fancy way of saying the biggest companies are driving the results inside of that ETF. So you're spread out, but close to 40% of your results are being driven by less than 10 stocks.
Yeah.
So it works great when those stocks are performing well and the market, the tide is rising, but we all know there are cycles to this. So when the script flips, you can expect the opposite to happen. So I think investors have been kind of lulled into this false sense of complacency of hey, the stock market only goes one direction. We've been around long enough to know that that reverses at some point, and you really understand what the implications are going to be of you holding this super concentrated investment as your only investment tool.
Yep. Yeah, that reminds me of a story. So met with someone, talk about their investment strategy. Long story short, they said they hated Elon Musk and Tesla and didn't want to own any. And I looked at their holdings. I was like, oh boy, I got some bad news for you, because your portfolio is 10% Tesla.
Yeah, it's amazing when you hear that stuff. It's and you can't really blame the investor that's not kind of paying it, doing their own homework, because they're just buying the name of the fund or the ETF, and they don't realize what's actually inside. But yes, pull open the hood, and it tells a different story.
Yep, for sure. So number 5, which is an important one, and we've touched on it a little bit. Retirement isn't only a math problem; it's a mindset problem. The biggest, I would still say the biggest risk is running out of money. You don't want to run out of money, but having a purpose in retirement, having a plan of the things that you want to be doing to keep yourself busy and to have fun, and to pay yourself off for all the work that you've done over the last 30, 40 years is extremely important, and I think it is most definitely overlooked. Especially, again, that meeting with me isn't necessarily the number one thing that they want to do that week. Just from the pure finance side of things, but they may be completely overlooking kind of when we retire when we stop working, when we stop having to get up every day. What are you going to be doing? And I've seen this unfortunately a few times. It's sitting home and watching TV is not really. It sounds like fun when you're working, right? But after a while, that gets pretty old. So having at least 3 things to do is kind of what I've been telling people lately. 3 places to go, whether that's your kid's house to watch your grandkids, and the golf course, whatever the case may be. Understanding kind of what you want your retirement to look like is a huge portion of this puzzle. So make sure you take a look at that too.
Yeah, and then I'd say, Derek, equally important is to put some kind of formal structure in place. Like take the time to define your goals and your objectives. Like why are you getting up at 7 a.m, right? What is the end goal? What are you trying to achieve? That way, I think it helps you have some motivation for the decisions behind what you're doing, each action. Okay, I'm doing this because it's helping me get to where I want to ultimately go retirement-wise. So you can enjoy all those things that you've decided how you're going to spend your time after working. And some folks, they love working, so they may just transition down into a part-time role, but they ultimately find that balance that gives them the most enjoyment out of life.
Yep, for sure. Yep. So, please, it's not in. I would say it's almost a generational thing as well, and that goes to having trouble spending money in retirement, because the mindset has always been saving. Now you get to spend. Now you have a retirement plan that says you can spend, and it's still uncomfortable. So that's why we do these podcasts. That's why we meet with clients, and we're not just talking about absolute rate of return. We're talking about their goals, right? We're talking about what they want to do. So all of it's planned in there. But it's also important to be talking about this stuff because it does become a real issue.
Absolutely. And there's so many studies out there that show when you have a goal, when you start tracking progress towards that goal, those people that take that step, they're far more successful than the people that just kind of wing it and say, hey, I'm going to do this today, I'm going to do that tomorrow, and you're not really honed in on where you're headed. Yep,
weeks can disappear quickly.
Yes.
So... All right, Dave, any closing remarks here?
No, I think this is all good stuff. I'm glad we're hitting on it's appropriate, and we're hoping Tony's ready to roll.
Yep. Get that tea going. Make sure that voice stays good. But yeah, guys, thanks for listening this week. If you have any ideas for a show, topics you'd like us to cover, or just general comments, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.